Hello, everyone. Welcome back to One Sustainability 2022 here. We are next joined by Dr. Henning Stein. He is the Global Head, Thought Leadership and Market Strategy at Invesco, and he is joining us today from Zurich. And his topic today is Investing in a Shared Future, the Role of Asset Management in Sustainability. Henning, great to see you again. Good afternoon. Thanks for once again being with us. We look forward to your remarks. Let me hand it off over to you, and I'll be back with you towards the conclusion.
Great. Thanks for the introduction, Glenn. And thank you, everyone, for joining us today. So taking part in this event and obviously showing interest in an issue, I think, affecting, I think everyone live on the planet, basically. And I'm going to talk about sustainability from really the perspective of asset management. So that's the sector I'm working in. And to put it another way, I'm going to talk about, I think, the enormous significance and opportunity behind this investing approach. And people sometimes tell me, approaching sustainability from a finance perspective is a little bit like trivializing the hugely important issue that is climate change. And they say, oh, how can you reduce, let's say, a problem like climate change through, making money? Or they say, how can you frame the future of humanity in terms of making a profit? I have to say, I don't see much logic in such arguments. I might even say I find them rather silly, because the fact is, bringing about positive lasting change is going to require money. Very simple. And how much money? Well, by way of a quick illustration, it's been estimated the journey to net zero global economy cost us roughly 300 to 500 trillion by 2050. I rather think 300 trillion. 300 trillion might be a reasonable number. And where is this monumental sum likely to come from? It's not going to come from world's governments only, at least not all of it, because it's a simple reason: they can't afford it. Much of it will instead have to come from the private sector, which is why many investors feel so passionate about their role and what they have to play in this shaping the sustainable future. And so during the next half hour or so, I will look at how asset managers and investors approach the issue. And we will also examine some evidence of how they might be able to help deliver the change. We'll explore the importance of long-term thinking of investment themes, and we will see how these underline sustainability as a source of some of the greatest growth opportunities ever. It's how I tend to look at it. It's more like from a growth opportunity than from a cost opportunity, because cost in the end means opportunity for investors. And then if we have enough time, I'll also consider the value of multi-stakeholder collaboration, which is very important, I think, in this context. But first, I'm a big believer in the idea of really understanding the past before you can understand the present and the future. So maybe let's quickly look at the history of responsible investing. And I ought to say at this point that responsible investing is known by many names. So several are essentially interchangeable. You will hear things like responsible investing and social and governance consideration, ESG. There's also a term such as ethical investing and impact investing. Let's tick these off as we go along and try to explain how they fit into the overall taxonomy and of responsible investing, because sometimes there is a little bit of confusion in our industry about these terms. Whatever we call it, so the concept is really simple and it's been around for centuries. Actually, in Jewish and in Islamic law, for example, there's a long tradition of investments having ethical constraints. So the Quaker movement is a great example, right? They were basically leading the abolitionist movement, avoiding investments linked to slavery. That was as early as the 17th century. Written works about the relationship between sustainability and finance also began appearing several hundred years ago. I'm proud to say, in my birthplace in Germany, we had Hans Karl von Karlowitz, and he arguably is the original trailblazer of this. He was a Saxon accountant and mining administrator. And in the early 1700s, he wrote a book entitled Silvicultura Economica. And this is now widely seen as the first really comprehensive analysis of what sustainable forestry means. And interestingly, it was written at a time when Saxony was suffering from serious resource scarcity. Another milestone was the work of political economist Arthur Cecil Purgue, a professor at my alma mater, Cambridge University, introduced the idea of negative externalities. And you still hear that word a lot today by politicians, externalities. So 100 years ago, shortly after Purgue outlined that notion of businesses having undesirable impacts, basically, you had the US Pioneer Fund, and they decided that they wanted to avoid investments in alcohol and tobacco. It was just their ethical belief, and so they excluded that. And then you go fast forward to the 1980s, and we see then the emergence of ethical investment funds. Again, a lot of this from the Catholic Church, for example, where we had as investment companies some early engagements on these matters, and these aim to really meet specific client mandates by excluding assets that these investors object to on, moral grounds, ethical grounds. And there's still plenty of ethical funds around today, at least in certain respects, and they function in much the same way as many of the formative responsible investments of several centuries ago. On the whole, though, I think really responsible investing as we know it today involves a much more holistic, much more integrated view, and one that is really drawing from qualitative and quantitative considerations. So it's not so black and white anymore. And I think it's an important point. We need to acknowledge really what we see today is really far removed from what you saw in historical milestones on this page, the early days. And crucially, I think it's also hugely removed from what it was only a few years ago. If we look back, early 2000s, we called it SRI. It was a totally different discussion, and in fact, has probably evolved more in the past 2 decades, I would say, than it did during the preceding 2 millennia. For my own part, I experienced this evolution early on, so it's more than 20 years ago, really. My first job at AXA, and it's been pretty astonishing to witness, the pace and scale of this development. I remember, I helped launch one of the first socially responsible investing programs for a retail audience in the German-speaking countries, and then we later rolled it out in the Netherlands and in France. And that seems like, really an eternity ago, given all the progress and innovation since. I've also been involved in the creation of several pioneering initiatives in emerging markets. I played a key role in building one of Europe's leading ESG management teams. And today I'm still engaged in designing, implementing product services with a responsible investing background. But I moved more towards the, I'd say, call it thematic investment perspective, where you as an investor, you want to get exposure to a theme, then, broad ESG capabilities. So how do asset managers, investors go about the task of investing in a shared future? Well, one thing I should make clear is that our investment approach at Invesco, it's really client-led, it's investor-led. So it's not top-down where we come with a political opinion. We really listen to the client and then we construct portfolios. And that's extremely important because I think attitudes, motivations around responsible investing, around ESG, they are continuing to evolve and they're not necessarily evolving in a uniform way. What I mean by this is that, there are no 2 clients that are exactly alike. And we need to be very mindful of that, if we construct an investment capability, we have different clients and we really need to be clear what their objectives are. And so views of responsible investing issue that vary really from client to client. So our job isn't really to drive a specific agenda on this. Like, and we see that some of our competitors do that, quite frankly, and I don't like it. I mean, our job is really a fiduciary duty. It's to help clients fulfill their own objectives, and that may or may not encompass all these facets of responsible investing. And for those clients who do not want to express this, it's fine. We have other capabilities, and those who do want to express their values, we also have approaches available. So this slide shows that we might call the spectrum of what we call the spectrum of responsible investing. And let me take you through the various phases here. First up is ESG integration. This basically involves taking account of financially material ESG considerations that could influence investment returns. We do this across our investment platform. So climate impact on, for example, an insurance company, that would be an example, an ESG consideration point that we would take into account when we say this is a good or a bad investment. And then some investors request an sort of exclusionary approach that I mentioned earlier, that we call simply screening. That would involve certain sectors, certain industries people don't like, and we just take it out. And this can be quite a simple process. For example, there may be investors who don't want to invest in alcohol or tobacco, just like that US Pioneer Fund that I mentioned 100 years ago. And then you get more sort of sophisticated approaches to avoid particular sectors, industry, companies. That comes after we scrutinize various ESG factors, and that can be thought as a form of enhanced exclusion. So, for instance, you could say, instead of excluding every company that's linked to tobacco, you might say, oh, just include only businesses that generate a certain percentage of their revenue from tobacco, right? And equally, it's possible to find reasons to include them as well, companies in the portfolio based on similar considerations. For example, some investors might look to invest in companies that are really great in a certain aspect, like treating workers, for example, so they're best in class in that particular performance. And finally, there's what's known as impact investing. And here an investor really has financial objectives, clearly a little bit secondary to the desire to then generate a demonstrable benefit for other stakeholders. And to put this form of investing into context, if this spectrum were extended further to the right and building on impact investing, the logical progression would be probably philanthropy, right? So some investors prize returns over greater good. Some want a pretty even balance between the two, and others consider serving the greater good the most important. Although I find this sort of distinction between performance and doing good, it's not always holding true. Sometimes it can be actually you can do the same at the same time. So it really depends on the type of the relationship is not straight. If you look at historic research, you won't find a clear answer to that question. So it might be the wrong sort of dichotomy anyway. If you go further with all that in mind, let's look at some of the real-world examples of responsible investing. And maybe let's begin with what many people see as the biggest threat currently to sustainable, which is climate change. I mentioned earlier the cost of achieving this net zero global goal could be something like $300 trillion by 2050. Let's look at the scale of that challenge now. So here's some data from the Climate Policy Initiative. That's a really respected independent think tank, and it shows the rate at which annual global climate finance flows rose between 2011 and 2020. You can see here that in 2020 the flow hit around 630 billion US dollars. This was split roughly 50-50 between government-related sources and private sources, so companies, private investors. And here's a chart, and that's a little bit shocking. You see the rate of progress against the rate at which flows actually need to go up in order to stay on the Paris Agreement preferred 1.5 degrees Celsius pathway till 2050. So huge gap. So the initiative estimates annual flows need to go up by at least 590% by 2030 if we are going to meet internationally agreed objectives and avoid then climate change's worst impacts. And my team is not convinced that the 1.5 degrees Celsius is a reasonable target. Actually not realistic anymore. But even getting close to that will obviously require really vast investments in climate mitigation, in adaptation over the coming decades. And interestingly, according to the Global Sustainable Investment Alliance, total assets under management for responsible and sustainable investment reached actually 35 trillion in 2020. So you see there's this gap. So you have on the one side, you have these ESG sustainable funds, and then you have still low numbers going directly into climate finance. If even you take Morningstar, right? Morningstar is a much more conservative estimate. They come to ESG funds at 2.5 trillion at the end of Q2 this year. But whichever figure you choose, and the disparity is obviously huge. You have to ask yourself, why climate flows apparently account for such a small proportion of responsible investments as a whole. And earlier this year, I worked on a project with Lord Brown, the former CEO of BP, and 25 years ago, he basically gave this famous speech in which he basically called out big oil to publicly acknowledge climate change. And we actually made the case for what we call the third age of climate finance. So the first age predated the Paris Agreement, the second followed it. It's basically where we are in now. We all acknowledge it. We try to screen our AUM and make sure these companies have plans in place. But there needs to be more, because these technologies need funding, right? And they're not coming from simply listed equities that you include or exclude from your funds. So you need a third age, so to speak, that brings in this or closes this gap that you see on this slide. So the journey to net zero may offer, I think, an unprecedented scope for growth. We're talking about really a tech-driven, innovation-led transformation that will reshape the economy, that will reshape our day-to-day lives. And it's a transformation that will involve multiple architects. You will have lots of enabling companies spanning, multiple sectors. And this is one of the reasons why it really represents such an attractive investment theme. And where's climate-aware investing having an impact today? Well, my colleagues at real estate, Invesco Real Estate, they have some really great examples where they can show that. And these include really improved costs on the buildings, because the buildings are basically under their control. More efficient use of energy, resources, even enhanced health well-being among the tenants. So why do we see so much impact in this arena? Well, the key point is that we have direct influence on the real estate space. And a major reason for this is we own the building, right? It's like on behalf of the clients, obviously, invest in the funds. And in other words, real estate provides us with real tangibles. That's why I like this space. And we know precisely, what we consume, how we can reduce it, and now how a certain level of investment then should change a building's performance, so we can measure the improvements. And such a direct relationship isn't so easily established in other investment arenas. And the one of the big challenges we face actually, and I'll discuss this detail in a few minutes. So let's talk about another arena where investing with sustainability in mind is really beginning to generate benefits that could eventually prove spectacular in their scope and scale. And I think the disruption of the global food system is something very exciting, because here we see really the broader issue of climate change firsthand, and it, I think, represents another extraordinary growth opportunity. We now have overwhelming evidence that the food system as it stands today has really become unsustainable, that it needs to be reformed from top to bottom and on a worldwide basis. So a significant reason for this is the system's contribution to the climate crisis. For example, there's a chart that shows the calculations for global greenhouse gas emissions by sector. And you can see agriculture, forestry, land accounted for nearly 20% of greenhouse gases that year. That's bad enough, but this figure can actually be much higher. Can be much more conservative. Actually, it's increasingly believed, if we take the impact of food and agriculture on climate, that this number of greenhouse gas emissions is closer to 40%. This is what some of the latest studies actually indicate, because basically the answer are cows, right? So you basically have to destroy forest and land basically to allow them to grass, and then that land can't absorb, or these trees can't absorb the greenhouse gas anymore. So more than 14% of all greenhouse gases are generated by livestock alone themselves. But then you add to that the factor, of taking away trees. So that's why you hear a lot of people, including myself, call cows the new coal, right? Cows are the new coal. And, removing all that livestock would very likely result in a much bigger net reduction in greenhouse gases than just 14%, because of this factor of the agricultural land. So nearly 80% of all agricultural land is now used by cows or livestock. So imagine how much CO2 from the fossil fuel industry could be absorbed if we instead used all that land to plant trees, or if we reclaimed all the Amazon forest lost to livestock farming, right? So the journey to net zero in many ways leads to the doors of the world's largest food producers, because it's a journey that can't be completed without big changes in the sector. And they're already happening, to be fair, right? These companies take that very seriously. They're working on solutions. So the big ones, Nestle, Procter & Gamble, Unilever, they really take this and they basically bring in new products that are more sustainable, plant-based, etc. And then you have to ask the question, where does the road ahead for the food system lie? As with climate change, it lies in technology. So radical innovation is becoming a consistently redefining what's possible. It's not about moral. It's not about telling other people what to eat. It's really bringing in technology to solve these problems. And the transformation, I think, is already underway in the form of, agricultural food technology. We call that AgTech, and we call that food tech. And we can think of these in terms of three broad categories. On the one side, there are the current technologies to improve existing methods. For example, a farm that would use digital sensors, machine learning to monitor and optimize crop growth. The second category uses current technologies to develop new methods. A good example would be vertical farming, where you produce, through stacked layers in a very controlled environment. And the third category focuses then on developing new technologies that will really disrupt in terms of radical disruption. A good example might be, alternative meat products grown in a lab setting through precision fermentation. The drawing on all these approaches, AgTech in particular has experienced major growth in recent years. This chart shows how global private investment increased between 2012 and 21. You can clearly see this is no fat. It's not a niche either. Investments in AgTech easily exceeded 50 billion last year, compared with, I think, just 3 billion only a decade earlier. A little earlier again in 2010, right? This sector was only 100 million. So you see these huge increases. And here's another snapshot of revenue growth in the global market for smart food. Again, look at the increase during the past 5 years, from around 350 billion to 525 billion. And I'm sure it's going to increase dramatically. There are some estimates we are going to 950 billion by 28. I need to watch the time. Thematic investing, I keep that pretty short. It's about technology. It's about, we can view this disruption basically in the food system as an example of this theme. And if you're interested and you believe in the growth, behind that theme, through an investment in a thematic fund, you can get exposure to such a theme. And I wouldn't call that, oh, I'm doing good. You're basically buying stocks in these companies. You're getting exposure to growth theme. And at Invesco, we like to frame this as a question of, realism and imagination, a balance of what's truly known, what we believe we know, and what we can't yet know for certain. It's about basically disruption and transformation, if you will. And that's why we look at the themes emerging now and try to understand, which will continue to have importance for our investors going forward. Ultimately, then, what does responsible investing mean for a global asset manager like Invesco? And in turn, what does it mean more broadly? We believe really responsible investing means creating long-term value for our clients, delivering benefits, but only for those clients who are interested. We would never come with a political opinion. You need to change the way you behave, the way you eat, the way you eat, or in the way you invest. So this is really up to you. And I find that very interesting. I've been involved, as I said. I also spoke about impact. That's a different idea. I don't think we have time now to deep dive into impact, but it's basically something where you get much closer to, I think, the private equity venture capital side of things, where your capital then directly flows into, for example, technologies that bring down CO2 in a meaningful way and very direct. Remember, this is a long-term undertaking. Definitive proof might not come tomorrow, next week, next year, or even in 2050. But that doesn't mean this is the wrong track to take. So that would be my final word here. And now I overrun already. So we have some time for Q&A.
Okay, Henning, thank you very much. Great presentation. Great job as always. Thank you for that. I'm a big believer in history, so I really appreciated your timeline, and I really believe that you have to know where you come from to know where you're going. So right. I found that really fascinating. Hey, just a real quick question on the journey to net zero. You're talking about technology and innovation. Any particular specific technologies that you've been seeing that might be helpful?
Yeah, I believe there are already technologies that can get us to net zero before 2050, by the way. It just needs scale, right? It needs money, right? And think about carbon capture and storage. It's big. Think about grid scale energy storage. So anything to do with storage. And then hydrogen, because hydrogen, you can also store energy. And then advanced nuclear. So far, by and large, I mean, the adoption has been hampered really by considerations, infrastructure, insufficient government subsidies, all these things. But if we really scale it up, and then, of course, if we panic and we can't do it, we still have geoengineering. That's another one people don't like to talk about. It's because it's really changing the weather patterns directly. But I would say these, starting with the ones I mentioned, like carbon capture, storage, grid scale energy, hydrogen, advanced nuclear.
And then one real last quick one before we sign off. You talked about the themes. I would assume some of those themes could track the UN Sustainable Development Goals.
Yeah, absolutely. So it's a very useful framework. We use it. All of our fund managers are using it, and you can track it down. SDG 13, for example, which is climate action. SDG 2, which is zero hunger, and break it down further, right? SDG 8, which is decent work and economic growth. I find that useful basically for fund managers to link their objectives. But you got to be careful. It's like, that this doesn't become like a marketing machinery. But I think as a framework, it's really useful to think about it like this.
All right. Well, Henning, thank you. Thank you for joining us today on our One Sustainability Conference. Great job as always. Henning Stein from Invesco from Zurich. Have a good rest of the day. Look forward to seeing you next time.
Thank you very much, Glenn.
Take care. Bye.